The question everybody's waiting to hear now is, when is the Fed going to finally begin reducing rates after having raised them to fight inflation and held them where they are now for quite some time. So there've been some good news recently on the inflation front. It's kind of, marginal good news, and it's not like, huge reductions in inflation, but it has in the last three reports been inching downward anyway, but still stuck. Well, maybe not stuck, but it's still at a level that's
Right.
relatively high relative to where the Fed would like it to be. We still have decent job growth. The economy is growing, although it's slower than it was last year. The unemployment rate is ticking up a little bit, but not dramatically. It's perhaps even like a healthy increase in the unemployment rate. So if Gordon, if you're on the Fed,
Mm-hmm.
how are you processing all this and thinking about a potential rate cut?
So, first of all, I think the way I talk about inflation is we tend to view this, I think, through three separate lenses. So first is, what is the rate of price growth just in absolute terms, and on that front, we remain unsatisfied as observers. Year over year, we're still at something like 3%. Second way to look at it is, what is the trend? What has been the movement relative to past prints? And there we've seen marked progress. The yearly rate is tending to come down. Saw essentially flat negative prints in the last, or negative readings in the top line and core in the last print, followed on the heels of a relatively good print before. So the trend in the near term is pretty good. One note of caution is we've sort of seen, particularly in the summer, we've seen some of these movements before, so false dawns on tempering of inflation. And so I note that for when we sort of talk about how the Fed's got to look at this. And then the third lens through which we look at these, I think, as observers, is sort of relative to expectation. So you take the trajectory, the trend, and other inputs in mind, and you formulate an outlook. And then if you can get upside or downside surprises, and then I think that can tend to really move minds. And some of the good news we've seen, some of it was expected. Most recent print, some of that good news was even better than we thought in terms of the taming of inflation. So that might pull your outlook a little closer in terms of when you're expecting some moderation in monetary policy. But also, as along the lines, as you along the same lines as you observed, we've seen some upticks in unemployment. We've seen some I would not necessarily signs of weakness per se, but weakening in the labor market. So the pace of hiring just on a monthly basis has plainly decelerated. I think the last month's jobs report was about 200,000 net payroll growth. About 70,000 of that was in government. Those can be aberrational. It's not necessarily the best look at the sort of pace of hiring in the private sector. We've seen steady increases in unemployment, 10 basis points, essentially for 3 months on the trot. We'd worry about that if that continued unabated. That gets us into that SOM rule territory, which we can revisit. Essentially a potential sort of leading indicator of a downturn if the unemployment rate really exceeds recent past the recent past averages. So all these come together to in an equilibrium that I think the Federal Reserve Chairman, in his recent testimony for the Financial Services and Banking Committee, he characterized these risks increasingly in balance, or employment and inflationary measures as imbalance. One trouble there, though, or one element of trouble, is that the last mile of inflation is the most difficult. There was some really great research by doctors, the doctors Romer, David and Christine
Christine,
on basically the track record of the Federal Reserve to stamp out inflation. And essentially what he found is that there's real risk in not being committed. And essentially they coded and characterized this central bank's responses to inflationary periods. And basically they failed and allowed inflation to persist in those instances where they weren't really willing to risk the unemployment component of their dual mandate. And I think we should be mindful of that, just the historical record and the record of the literature, but also some of the comments from Chairman Powell. I think he really marked a signal change in the Fed's direction, way back in 2022, I believe it was Jackson Hole, where he was saying, we are going to control this and we will march inexorably towards that goal. And so when I read Goldman Sachs sort of putting out reports, I think this week on why wait, somewhat making the case for a July rate cut. Well, that's why you don't, that's why you wait, is because there's real risk that you're going to fail to control inflation. And then with other elements in the macro economy, you could see ourselves in an inflationary environment while facing a downturn. And you want to tame inflation first.